So I'm here at the Evolution of High Value Payments panel, which you've just come off on. One of the things you talked about was that the evolution of high value payments was sort of kick-started by the liquidity crisis a few years ago, the financial crisis. I mean, Harry, I'm going to direct this to you. I mean, as a member of SWIFT, which is owned by the banks, how have the banks handled this sort of forced evolution?
Well, I think the crisis caused a number of things to happen. I mean, first thing it does is it says it made liquidity a scarce good and made an expensive good. So previous to the crisis, there had been plenty of liquidity, and high-value systems need liquidity to operate. So now we're busily working with a number of high-value systems about how to make them more collateral efficient, to use less liquidity. And the other thing it does is that it pushes the central banks and the regulators to put more regulation into the marketplace about regulating the banks and how they operate, and in terms of managing their liquidity. Because the crisis wasn't a crisis of insolvency, it was a crisis of liquidity. Even Lehman's wasn't insolvent, actually, it was illiquid. And so you have these two distinct trends going on. One is about the scarcity of liquidity, and one is about the greater regulation, and working with the industry to actually make those work in parallel is going to be the real challenge in the next 2 or 3 years.
It's great that you brought up regulation, because that brings me to my next question to Martine. You gave a lot of calls to action while you were sitting on the panel, so I really wanted to know from you, I mean, what are you demanding from central banks in regards to regulation that's affecting high-value payments?
So considering the high-value payment system, I mean Year 1 and Target 2 at the European level, we are expecting the central banks to apply exactly the same rules to their system, Target 2, as our system Year 1, firstly, so that there is no competition distortion between the two. And the second point, which is very important for us, is that if there is any governance issue with the commercial system, we will expect that the central banks will apply the same rule for their own system. And in particular, if I look Target 2 system, we would expect the central banks to create a kind of board of directors, and within this board of directors, instead of like today being only managed by central bankers, we will expect to have a place within this board.
Great. We can talk about regulations for hours, but I wanted to move over to Patrick, and thought it was very interesting that you made a few statements about the evolution of high-value payments which were seen by some as a bit contradictory. Like, you sort of made a prediction that high-value payments would become a niche product, but then you sort of backtracked and defended yourself and said, well, no, the private sector really has a place. So I was wondering if you could sort of go into a bit more detail about that.
No, I think it's not contradictory. I think they do cover a specific role since a long time, the clearing and settlement of very important systems, payments which need to be settled with certainty in central bank money, same day at least. So that is a specific role. That's why they are a niche product. They should not try to compete, as has been the temptation by some central banks, with retail payments, which have another function. Having said that, it doesn't mean that because of this specific role, they should be only in the hands of central banks. I think there is a role, especially for large currency zones, maybe not for small countries as Harry mentioned, but there is in the large currency zones, the euro, the dollar, a place for a private sector initiative, a private sector infrastructure next to the central bank infrastructure. And I think this brings healthy competition. It gives the banks the control over the systems, which you do not have entirely when these systems are operated by central banks. That was really
interesting. I mean, I'm going to go to you. I know you did a really good job moderating, Christian, but I thought it was an interesting discussion you guys had at the end, especially with news coming out of the UK and there's news in the US about keeping the retail banks and the investment banks separate. And you talked about our cash and securities markets coming closer together. Is that possible to be done without merging the infrastructures, or?
I would look at this from the cash side first. Let's face it, in the financial crisis and in the aftermath of the crisis, high-value payment systems and infrastructures performed very well. So there were no frictions in the high-value payments clearing. I believe the first principle is do not change what is not broken. So effectively, these systems work effective, work efficient. You can improve distribution of liquidity intraday liquidity management, etc., but from the basis that it is working at this point. What I mean with cash clearing and securities clearing working closer together is, let's say, optimizing the flows between the two. But at that point, not jeopardizing the effectiveness and the efficiencies of current high-value payment clearing infrastructures and also bank operations.
Excellent. I'm going to leave that there because I think you guys now deserve to have lunch. So thank you very much.